Hey everyone, and welcome back to Am I Catching a Falling Knife? I'm Dave. Today, we're diving into Monday.com, ticker MNDY. This stock has taken quite a tumble recently, dropping a staggering 38.70%. So, is it a bargain, or is it truly a falling knife we should steer clear of? Let's find out. That steep 38.70% drop for MND wasn't just random market noise. It's largely attributed to the market's reaction to their Q2 2025 earnings report. Now here's the kicker. They actually beat revenue and EPS estimates, and even raised their full-year guidance. So why the plunge? The market perceived their Q3 outlook as conservative. It's a classic case of expectations overriding actual performance when it comes to growth stocks. But before we dig deeper into that, let's understand what Monday.com actually does. MND is a global software company, a big player in the low-code, no-code work OS space. Think of it as a platform where organizations can easily build and manage their own work tools and applications without needing deep coding skills. They connect people, processes, and systems, making businesses more efficient. With about 245,000 customers across over 200 industries and actively integrating AI into their products, they're clearly a significant player. Now let's talk about that conservative Q3 outlook and its impact. How did a seemingly positive earnings report lead to such a massive drop? Let's break down the market's thinking. First, even though they beat Q2 and raised full-year guidance, the specific Q3 outlook, or what the market expected for Q3, clearly disappointed. This suggests a significant recalibration downwards of near-term growth expectations. Second, Monday.com operates as a single segment, their work operating system, and boasts an incredibly high gross margin of 90%. What does that mean? It means any perceived slowdown in revenue growth, even a slight one due to a conservative outlook, flows through very efficiently and directly impacts their gross profit and ultimately their earnings. Operating expenses, you see, are relatively sticky, so a small revenue hit can have a big earnings impact. Third, while they raised full-year guidance, the market's strong negative reaction specifically to Q3 implies that the previous consensus for Q3 was much more optimistic. My analysis suggests the market is now factoring in Q3 quarterly earnings that are approximately 7.5% lower than their prior, more bullish expectations. We're looking at an estimated negative impact of around 7.5% on those Q3 earnings, with a confidence range of 5% to 10% because it's based on a perceived conservative outlook rather than hard numbers. It's a moderation of growth expectations, not an absolute decline, but enough to trigger this kind of re-rating. So, with that impact in mind, what's MND really worth? To figure this out, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm assuming a future annual earnings growth rate of 20.0%, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Based on the company's fundamentals before this narrative hit, my DCF model gave a base value of roughly $22.06 per share. But applying our narrative's estimated 7.5% negative impact on Q3 earnings expectations, that DCF valuation drops to approximately $19.86 per share. That 7.5% perceived hit translates directly into a lower intrinsic value. The second method is a bit simpler, a PEG-based valuation. This takes into account the price-to-earnings ratio relative to the company's expected earnings growth. Based on MND's current PE of 234.93 and an EPS growth next 5 years of 20.03%, this method gives us a fair value of around $22.23. You can see there's a bit of a range, but both suggest the valuation has adjusted significantly. Given all this, and considering the market's current sentiment and MND's underlying business, if I were looking to potentially step in, I'd be watching for some more significant pullbacks. My custom buy levels for MND would be around $100, $70, and $50. These are levels where the risk-reward profile starts to look more compelling given the recent volatility and the adjusted valuation. So, that's Monday.com. Remember, this is not financial advice. I'm just an engaging financial podcast host breaking down complex topics for you. Always do your own thorough research, consult with a financial advisor, and understand your own risk tolerance before making any investment decisions. That's all for this episode of Am I Catching a Falling Knife? Thanks for tuning in, and I'll catch you next time.